purchased something from my vendor, and how much am I, like, it's coming into the business as sales, as revenue. How much are customers paying me right now? And we've got three major types of cash flow: operating cash flow, investing cash flow, and financing cash flow. Operating cash flow, that's the basic, it's used for, day-to-day businesses, day-to-day operations rather. So operating cash flow just focuses on what's the sales like, what's my rent, what's the salary, what you do regularly. That's the operating cash flow. Investing cash flow is the money that you use to purchase long-term assets. You use to purchase your equipment, you use to purchase properties, or is the money you get in, it's two-way, out and inflow, right? Inflow and outflow. So the money that comes in under investing cash flow is what you get when you sell long-term assets. You sell properties, you sell like old equipment that are no longer functional, you don't need them anymore, you need to upgrade. Those are that's what we call investing cash inflow. Then the last one is financing cash flow. That's the form of equity. That's money that you get from investors to be able to, expand your business, or to even start your business. The initial capital that you even used when you were starting your business, maybe business registration, buying, a few goods, the money that you spent is classified under financing cash flow, is what you use to finance your business. And I don't know if you've heard this before, but cash flow is king. It's a common saying.
This meeting is being
Cash flow
recorded.
is king in any business, and that's because cash flow is the bedrock for which business meets their obligation. So if your business does not have funds, does not have cash in it, it cannot provide services. It cannot, supply goods. You need money to talk to your vendors in China. You need to pay them. So cash flow is the bedrock for which businesses meet their obligations. It's very, very, very important. A company, a business cannot operate without cash flow. It's very, very, very important. You cannot do anything without money. It's got ego, it's got kudi in different languages, but it is king in the business. Then we'll be discussing what is profit on the next slide. Yeah. So profit is simply defined as the excess income after all expenses have been deducted. Remember what I said? Excess income, not excess cash. It is called excess income that you have earned after all your expenses have been deducted. And how do you, classify profit? You've got gross profit, you've got operating profit, and then net profit. Gross profit is, I sold this. How much did it cost me to sell, to be able to sell these goods? So, for example, it's a food business. Somebody placed an order for meals. You bought the ingredient, you bought oil, you bought gas, everything. That's your cost, the cost that you used to be able to fulfill that order. So the sale amount that you get, maybe $100, and your cost is $50, you've got like a gross profit of $50. Operating profit is the gross profit that you had gotten when you made the sale, and you deduct your operating expenses. Operating expenses in this case include rent, includes salaries, it includes what's it called? Subscription. Sometimes you subscribe for certain things. So all those other things that are not directly, impacted, or they're not directly attributable to that good or the service, all those ones are classified as operating expenses. So maybe like what example again would be logistics. Yeah, that's part of operating expenses. You put that in the bucket of operating so that you understand what is then your operating profit. Then lastly, we've got net profit. Net profit is when you deduct all other expenses and taxes from your operating profit that you had initially calculated. So gross profit, just to summarize on this slide, gross profit is shows the performance of your business. It indicates production efficiency. Then operating profit, it measures your core profitability, while net profit is the bottom, is whatever you have after you've paid the tax man, after you've paid like interest. Interest payments as well. So that's like the bottom line, whatever you have after you deducted every other thing, that's the net profit. What's the importance of profits? Profit helps to show you the performance of your business. It tells the story about your business in measurable terms. So somebody comes to meet you and say, oh, you've been in this business for 5 years. Oh, tell me the story about your business. You have to speak numbers. You have to say, oh, yes, in the first year, I started this business, or we made just 50K, but in the next, in the second year, profit grew by 50%, it's been growing by 20%. You have to tell the story about your business. You have to use numbers to tell your story. So profit would, that's what major investors like to see as this being able to generate profit over a period of time. Thank you. Next slide, please. Yeah, so the key differences between cash flow and profits. Like you see here, cash flow majorly just tracks your cash movements, what is coming in, what is going out. And this is where quite a number of businesses make the mistake. They see cash flow and say, oh my God, I'm making so much money. My business is thriving. No, hold up. Your business may not, let me not say it's not, but it may not be thriving. You need to chill. You need to look at these numbers properly, because the fact that cash is coming in does not depict profitability in any way. And then profit also does not necessarily mean that you've got cash. So your books can be showing, oh, we're making profit, but you're like, where's the money? I can't see it. Because they are two different things. And that's why you got like cash flow statement, and then you got the income statement. Income statement is where you report your profit. Cash flow statement is the one that shows the level and the movement of cash over time. So you need to understand that because I'm generating cash does not necessarily mean that it's profit. Your numbers may look great in terms of profit, but then the business is running low on cash to pay suppliers or even to pay salaries. Yeah, and so they are totally different. So to differentiate this, when you make a sale, you get you most likely will get cash from your customer. But then what if your sale like credit terms on that sale? Maybe you're like, oh, just to make the customer comfortable, depending on the business that you run anyways. You can say, oh, okay, don't pay me for now. Then when you use this product and you think it's good, you can pay the balance. Different businesses have their credit terms. So if the customer does not give you the money immediately, it doesn't mean that you haven't made the sale. You have made the sale. That will be in your income statement. It goes in as sale. But your cash flow, you cannot say you received cash. So I don't know if we get that. That's a major difference. Cash, you collect the cash. But in terms of your sale, you record the sale once you make that sale. Once you probably send an invoice. Once you send your invoice out, there's a sale. But it doesn't mean that there's cash until the customer pays you and provides like proof of payment. That's when you can recognize cash. But once you make a sale, you've made that's recorded, and that impacts your profits. And same thing, your suppliers come to you and you want to you go to them, you want to buy stuff, you want to place an order for stuff. Some suppliers are gracious, they've got credit terms as well. But once they give you the invoice, they give you the invoice this time around, you get it, you put it in your books and records, you recognize the purchase, you recognize the cost, but it doesn't necessarily mean that cash has gone out, right? So the timing of when you pay or you receive the receive the money, that's how that's what determines your cash flow. But once that sale is made or once a cost is recognized, then that impacts income statement, and from there we're able to determine what level of profit we've earned so far or not. So just to make you understand that you make a credit sale, you don't have cash, but you've got sale, you've got revenue. Your supplier gives you goods on credit, you've recognized your cost, but actually you've not paid yet. So you need to be able to tell that difference and not be swayed by, oh, I've got so much money now, I can blow it up, I can spend, I can do this, but then forgetting that these things are different. And if you don't take precautions, this not like, so when I say if you don't take precautions, if you do not plan appropriately, financial planning, if you don't do your budget properly, the business might run into problems later, that you might not be able to fix. So we have to be very mindful and not confuse cash flow with profits. Next slide. Why does differentiating cash flow and profit matters? Why? Number one, because business need enough liquidity to cover their expenses. You need to be able to time the liquidity of your business. You need it. If you misinterpret cash flow and profits, that would result into poor financial decisions. So you need to know, the liquidity status of my business. Am I liquid enough to be able to purchase some goods from China or from America? You need to be able to do that, so you are not in a fix, and then you're owing suppliers, you're unable to, customers are asking, where are my goods? Where are my these things? And then you're like, oh my God, how do I pay? Like, how do I even meet up with my obligations with the vendors, right? So it's very important that businesses, have enough liquidity. So when you're able to differentiate between your cash flow and your profit, you
This meeting is being recorded.
budgeting. Liquidity is very important for business to cover their expenses, the rent, the salaries, all their immediate costs, branding, everything. So you need to this is one of the importance of cash flow, differentiating between cash flow and profit, because you need to be able to time when you will pay off all those bills. It's going to help you with planning and budgeting. It also prevents business failures due stages. I said it before, you need to be able to time your liquidity. If you don't, the business is going to run into problems. But then with sound financial planning and budgeting system in place, your businesses are able to avoid debts and also to ensure there's sustainable growth. So in summary, differentiating between cash flow and profit matters so that the business can thrive, so that the business can enjoy sustainable growth. Yeah. Next slide, we're speaking to the common cash flow mistakes by business owner. I mentioned that before. Many businesses think that, or business owners rather, they think that once they've got cash on hand, oh my God, they are good. No, it's not. You're not necessarily good. The first point on this slide says that you assume your invoice sales equal cash received. I hope that is clear now from the example that I had previously explained. Because you've sent out your invoice to your customer does not mean that you received the cash. Yeah. Some businesses, once the cash comes in, they're like, oh, let's quickly buy this, let's stock up on this because Christmas is coming, this and that. But then forgetting that there are probably other expenses that will come up. Maybe rent is going to come up at some point in time. They need to account for that. They need to prepare for those expenses. Or you need to be prepared for other financial obligations. Some businesses have got loans, there are interest payments. You need to be able to plan. You need to be able to plan so that the banks don't come knocking and just want to get your collateral. No, you need to be able to plan. Don't see cash as you doing well. Be careful. Slow down and look at your books. Who are those that I'm owing? When am I supposed to pay them? And don't just go, boom, let me just order stuff because there's a seasonal sale coming up. No, you need to plan appropriately. And then some other emergencies can come up, right? I remember, I think it was COVID period, that there were so many damages. In Lagos, it was the Surulere Mall. So many businesses were affected by that, by the events that happened at that point in time. Imagine if some of those businesses did not have insurance. How would they have been able to repair their stores, stock up again, and all those things? So every business, like we human beings, the way we save, we call it save for raining days. Businesses also need to keep cash, for unexpected events. And being able to save for periods when certain things would happen. Right. Yeah. So business owners also use their funds when there is an order without tracking the inflow and outflow. Sometimes we business owners, we put in our funds into the business, right? We say, oh, I think this going by, social media, whatever, you probably done some market analysis and you've seen that certain things are going to pick up, or you've got the foresight. Somebody tells you and gives you an insight and says, oh, I think you should stock up on this stuff. So you use your personal money to do that. Because you've used your personal money to do that, and then you get sales, like your business generates sales, does not mean that you necessarily have to just dip your hands into those funds and just take your money back. No, you need to track your inflow, your outflow, and ensure that you're not putting your business in a funny situation. So next slide, we're talking about the best practices. What can we do as business owners? How can I help myself? How can I, ensure that my business is not lagging behind on obligations? How can I ensure that, banks are not always like my health is at risk when it's almost 25th of every month. It's time to pay salaries. How can I ensure that my business, is in a good state, is healthy, has a healthy cash flow? Yeah. How do you do that? You have to monitor your cash flow. You have to draw up a plan. You need to have like financial projections. You need to have forecast statements. These things are simple. Don't mind the English that I'm, the words, really, they are simple to do. It's not it's not rocket science. So there are easy things that you can do to monitor your cash flow, ensure that you are healthy cash wise, and you have to make sure that you maintain a balance between your receivables and payables. Receivables here means people who are owing you, customers who are owing you. Payables are the vendors that you owe. You've already collected the goods from them, but you are yet to pay them. There's a timing difference between it. So you need to track my receivables balance. Oh, customers are owing me 100 million. I'm owing my vendor 50 million. Okay, when is the best time to pay? Some vendors can tell you, okay, take the goods for 30 days. Don't pay me. But if you don't pay me within the 30 days, I'm going to charge you interest. So if you don't want to incur the interest, you make sure that you pay them. So you have to do the scale, weigh the cost and effect. Should I pay them within 30 days or should I chill and then I pay them some other time? So you need to adopt that practice of always monitoring your receivables and your payables. And then lastly, you need to adopt the use of financial tools and software to better track your business. You need it. It's very, very paramount. Timely bookkeeping is very important for every business that wants sustainable growth. You need to create for the cash flow projections, you need to create maybe like monthly forecast or even quarterly forecast or even weekly, depending on the size of your business, depending on the volume of your transactions. You need to ensure that you put that system in place, right? And then you also need to make sure that your budget, you don't just have the budget for, let me just have it because I'm budget. No, you have to track it. You have to review your budget frequently. You don't wait until there's like a major hit and you're like, oh my God, what's going to happen? How can we fund this? No, you need to set a timeline, or we could say monthly. Organizations do like monthly budget review or quarterly, half yearly, and all of that. As businesses, you need to adopt that too as well. So you need to track your budgets periodically, checking on your business. I would say checking on your business periodically, just like we do regular health check on our bodies. You also need to adopt that as well. The next slide, that's where we're going to be talking about the tools and the software. How can you automate tasks by using accounting software? You know, this is like the crux of this presentation. What are the tools that we can adopt? What are the softwares that we can use, to be able to make better financial decisions for our businesses? And the first tool I would recommend, depending on the size of your business, would be the QuickBooks. It's a software. You can download it on your phone or your computer. You can download it on your phone. It's easy to use. There's the free version, there's the paid version, depending on the level at which you are with your business, right? So you download it. It's so cool that even if you do not have like prior accounting knowledge, right? There's like the way you download the software and then you can read through it. It's so easy to use. It's user friendly. Yeah, I would say that it's very user friendly. QuickBooks and Zero, QuickBooks Zero and Zoho Books. Yeah, they are very user friendly. You can so I wanted to explain how you could use this too as well. So I know some people have got like businesses that they can generate invoices. They just have this tool. They have software, rather. They have a tool that they just use to generate invoices, and that's it. That's the only thing that it does for them. But regards to Zoho Books and Zero, once you generate your invoice, as long as it's already set up, yeah, you might need someone to help you set it up, but you can do it yourself, to be honest. As long as it's set up, once you generate your invoice goes like the sale amount you put in goes directly into an account or a GL, general ledger, called sales or revenue. So it's your income statement starts to build automatically, right? You can have customer names. So once you try to generate your invoice, it asks you for the name. You set it up there. You have the customer name. You type it in. With that level of detail, you can track how much sale you generated for customer A at the end of a month, or at the end of a quarter, or the end of the year. So you can generate, like you can be able to tell numbers will tell, then you can also put in like vendors invoices as well. Once you put those in, you plug them in, your cost base gets set up, your purchases get set up immediately. You put in expenses, your salaries, your staff salaries, repairs of motor vehicles, gas for generator, fuel for your car, everything, every expense that you incur is so easy. You just type it in. You can link your business bank accounts there, so that when you slot in, for example, you post a sale by customer, the customer here buys something from you, you put in sale $50,000. It asks you what bank. You choose the bank depending on the way you set it up. You choose the bank, you type it in, and then so it goes directly into that bank. So at every point in time, you can have an idea of how much you've got in your bank account. And when you use these tools as well, you can generate your income statement, your cash flow statement, your balance sheet, just from the tip of your hands. Like you will just be able to see everything on your phone. But then for those who've got like, multiple businesses, corporations, big businesses that are already standard, they can choose to hire like an accountant, a bookkeeper, or once they still have their automated system in place, they can also still maintain the bookkeeping. And I would say as business owners, learning is continuous learning is very important. So keep looking out for resources online, on YouTube, on Instagram, even TikTok, that would help your business as you journey to towards sustainable growth. So download all this. I encourage us to download some of this software on our phones, our computers, and set them up, so that we can track our businesses. The essence of having a good all this in place, a robust accounting system in place, is so that when we've got investors, people who are interested in our businesses, they want to see the numbers. They don't just want to, yes, they believe in you, they trust in you, but beyond you, they want to see what your business has been able to do. So this software will produce like several data points that you can be able to. And I also wanted to highlight that these softwares are not just focused on people who provide that sell goods and services. If you're a freelancer, you can also use this as well. So you can tell, oh, where am I even getting my jobs from? Is it from the US or from Canada? You can tell the data points are there. FreshBook, I would say, is very ideal for freelancers. Maybe you do like artwork, knitting, whatever, or you're a publisher like Senior B, you can also track all these things. You want to track it and see, is this business actually worth my while? Is it actually worth my time? And am I able to build a legacy from this business? So, and as your business grow, you decide, what you want to do going forward. So to conclude, yeah, in summary, I would say that as business owners and kingdom financiers, you need to give your business an upgrade and set up structures. We say it often, God is a God of structure. So why not implement that same structure? Or, why not implement structure in your business? Why just leave your business just like, oh, let it go? Let's just be doing it. No, you want a business that can outlive you. You want your business to become the next Walmart or the next Volkswagen. So why not put the structure in place? And